We work with funders based on the continent as well as across Europe, Asia a little bit, as well as North America. And these folks are all across that spectrum. Right? There are some who are primarily cared about impact and are mostly grant funders. There are others who are more commercially minded and care about finance. And then there's a bunch of them that are in the middle as well. And our job is to work with clients to help them figure out who amongst all of those is the right fit for you, given your cash flows, your potential impact, and the way your business is actually structured. And that's an important piece to think about when you're raising funding. Like, who actually makes sense for you to go to? Because a lot of these funders will have their own priorities as well. They might say, I'm only interested in energy, agriculture, and water and sanitation. If you're a business in financial services, you can't go to that funder. Unless you can say, look, I'm actually lending to people who are buying solar products, then maybe you've got room for that, right? So it's important to know what are these funders' priorities so that you can understand how you position yourself as a business. Or they might say, I'm only interested in funding companies that need more than $5 million and are looking to raise in debt or some sort of quasi-equity instrument. If you're looking to raise $2 million in equity, again, you may not be the right fit. Does everyone know what I mean when I talk about quasi-equity? Okay, a lot of no's. All right, so real quick, in terms of funding structures, everyone knows debt, right? So you go to a bank, they give you money, you repay them, say 2, 3, 5 years later with some interest on top. Does everyone know what equity means? Dragon's Den, Shark Tank, etc., where it's I give you money, you give me a percentage of your company. How we figure that out is a whole art and science unto itself. There's a range of financing in the middle called quasi-equity, right, which has elements of both. So for example, that could be, I'll give you $1 million today. You'll repay me that as if it's a loan. But at some point in the future, I have the option, if you've repaid me $400,000, there's $600,000 left. I have the option to convert that into equity. And then instead of then you repaying me the remaining $600,000, we turn that into a percentage of your business that I now own. Right? That's called a convertible debt. So, and there's a whole host of different other structures. It could be a revenue share, profit share, a number of others as well that fall in between that spectrum of debt and equity. So when I talk about quasi-equity, that's what I mean. Clear? All right. So the important thing to also consider is not just what are investors' priorities and areas of focus, but you also have to remember where their money comes from. So, and that often influences how they determine where they invest and how, right? So at the top, you've got what you call limited partners, right? So those are the folks who actually give the investors their money, right? Many investors, so you have different types of investors. We'll get into that in a bit as well. For example, angel investors are usually high net worth individuals, basically just rich people. But you have a whole host of other types of investors who will go to those rich people or go to governments or other entities and say, look, give us your money. We will invest it for you to meet the things that you want to achieve. And then we will return that money to you along with some additional interest on top. Essentially the same way a funder would do to you, they have people that fund them. And those people often define what the investor's mandate is. They tell them, these are the results we want to see, or they agree on that together, around the results they want to see, right? And then they deploy capital into those businesses. So often, those investors' mandate is defined by their agreements with their limited partners. So it's important to understand what that structure looks like. And it's also then important to understand what does that mean in terms of life cycle of those funds. So there's a range of different types of funders. One of them, many of them we work with are funds of some sort, so family foundations or impact investment funds. And these guys, the general partners, will go to the limited partners and say, look, give me a bunch of money. In 5 to 7 years, I will return that money to you with interest and with demonstration of the impact we've achieved with that money. But that means once they get that money, they have a window where they can invest that, right? Because if it takes a business, say I give you money and you as a business need, let's say 5 years to actually either repay all of it or to achieve some sort of return on the equity, maybe you raise another round, or you sell the business to someone else and then I get a return from that, right? If you need 5 years, that means that when that fund raises, if they have 7 years to achieve their objectives, you have to meet them in the first 2 years, right? They have to give you that money in those first 2 years of the fund so that you then have the remaining 5 years to return the money to them and their interest and return on top of that. And then they can go back to their funders and say, we've achieved our objectives in 7 years. So you also have to be aware of kind of where's the fund in their life cycle, because that influences their ability to invest. Now, if you catch them right at the end where they're like, we really need to get money out the door, that might work to your advantage, because then they're willing to just deploy funds. But those are the ways that funds are structured as well, that influences how you can get funding from them. All of that clear? Questions so far? All right, write the questions down as well as we go, and we can talk later. So the other piece then is understanding, as your business grows, what actually makes sense for you, right? Not all types of funding is suitable for different types of businesses. As we talked about earlier, when you're looking at grant funding, or kind of low stakes funding, so this might be from your friends or your family, or someone who just has a vested interest, you're looking at generally funding that is not commercially sustainable. Right, you're not in a position to provide a return. You may not necessarily have, say, a viable product yet. You may not have a good understanding of your market. And it's just, look, I need money in order to figure out what our business model is, right? And this also applies then to folks who are never meant to be commercial entities, right? There's a mix of different types of organizations. There's a bunch of them that shouldn't be businesses, and that's absolutely fine. But that does mean they rely on donors and other types of funding. As you scale, you then start to be in a position to take on different types of funding, right? So the thing to remember is that for investors, really the key thing they're balancing is risk, right? Investment is all about risk. What you want to do is you want to place capital to maximize your potential return, right? Ideally, it'd be great if I could say I'll achieve, 100% return on the money I invest, meaning I give you $1 million, I get back $2 million. You want to maximize your potential return, but minimize your risk as much as possible, right? Because the idea for investors, if you're looking at, for example, equity investment or angel investors, which again are mostly just really wealthy people often, but angel investors are typically defined as folks who come in really early stage. Right. So, for example, if you've watched Shark Tank, Mark Cuban might be considered an angel investor. And for them, they recognize that the risk they're taking is higher because the businesses they're investing in are earlier stage. They haven't proved their model yet. It might be a good idea, but they haven't quite figured out what they're actually doing. And a lot of businesses, and Java can tell you about this, will pivot. Where they started actually might be very different than where they end up as the business that actually makes money. So that investor is often betting on the team and saying, I really think like you have the ability to do this, even though your business may not actually be ready yet, and you may not have figured out what the right model is. So for those investors, when they come in at that stage, they're taking a lot more risk. Whereas if a bank comes in later, right, a bank is going to tell you, I need multiple years of audited accounts. There's a lot that they want to see because banks are some of the most risk-averse investors on the market. And they want to know it's almost a guarantee that I will get my money back so that the percentage of defaults they get is really low. So they're much more risk-averse, but they then recognize that their return might be a bit lower. So for an angel investor, what they might say is, I'm going to give a bunch of small companies smaller amounts, right? Maybe I'm giving them all $100,000 each. I recognize because the risk is so high, a bunch of these companies will fail. And that's the truth, right? The majority of companies fail, unfortunately. That's the world that we live in. But that angel investor will say, my hope is that a couple of those companies will succeed enough to the point that they offset the loss from the other companies I invested in, as well as then provide additional return on top of that, right? So the stage that you're at also influences the type of investors you want to go to. And then as you grow, those investors shift. So you can focus more on quasi-equity. You can look at venture capital as a potential area for investors. And then when you're really large, you're looking more at debt, right? Where it then comes into kind of your traditional financial markets in terms of banks, private equity firms, and so on, right? So the important thing to keep in mind is understanding what are investors' priorities, what are they focused on, what is their stage of investment that they're interested in, what sectors, what types of return do they expect? Are they expecting minimal return if you demonstrate impact? Are they expecting market returns, which might be comparable to what you might get at a bank rate? Right? So you have to keep all of those in mind when you're thinking about different types of investors. And you need to evaluate those investors as well. Because you don't want to spend a bunch of time trying to get an investor interested in your business if, because of how they invest, they're never going to invest anyway. Right? So you need to focus on the ones that are a good fit for your business.